Welcome back. You're watching us here on Halftime Report. Let's get chatting with the management of Sasken Tech. They reported a weakest set of third quarter numbers. The revenue and the EBITDA margin contracted, and the total order wins for the quarter was just shy of $30 million. Rajiv C Mody, who's the CMD of the company, joins in now. The stock down by almost 3.5% itself. Rajiv, thanks a lot for joining in. I'm just looking at some of your numbers. There's been a sharp revenue drop 6% quarter on quarter and 21% year on year. Is there any particular reason for that? And what's your outlook for the remainder of this year basis this?
Yeah, thank you for having us on the show. So from a revenue and EBIT margin, I agree. I think the numbers were not in line with our expectations, primarily because of the fact that we concluded a large program and that had an impact on the third quarter. We made an announcement on that program also where we delivered world's first LTE terminals for satellite communications to the world's best discerning customers. So I think that is primarily the reason. However, I think during the quarter, we have had a good run-up on the new revenue bookings that we have done with our existing customers and added few new customers. So I think that momentum is a positive thing, and the impact of that you will see in the current and the going quarters as far as revenues and margins are concerned. We continue to see a momentum also on the new revenue build-ups as we are speaking. So I am quite positive in terms of the growth trajectory that we have decided to go on. So overall, from that perspective, I think it was a satisfactory quarter.
Okay. How would you explain this sharp drop that you've seen in your margins this quarter? 5% versus 14.2% Q on Q. And what can you guide on?
I think the primary reason for that is twofold. One, the program that we concluded was a good margin program, and due to that, there was a contraction on the overall mix. So that is one primary reason. And the second reason is that we are investing in building up our capability, our bench strength, as well as investing in future technology. So below the line costs also, we are consciously increasing to ensure that we are serving our customers to the best of our abilities and growing our business rapidly with them. So going forward, I think our focus will be to see how we improve the margins, but not at the cost of not investing more and more to see that we really drive significant growth in the coming financial year.
You have used this word significant growth a couple of times in our conversation so far, Rajiv. So I just wanted to know, how do you define significant growth? By when do you get to that significant growth? Because the first 9 months of this year, your revenues optically are down around 13.5%, maybe because of the program that you ended, which you spoke of. Significant growth, what is it that the company is eyeing, by when? And at that level, what are the margins that you're likely to work with? Because 14% has turned into 5%. Are you looking at high single digits, perhaps double digits, even if, that does not impact your growth plan as much? What's a sustainable number here is what we're trying to understand.
Yeah, so on the margin one, I think we will definitely driving the EBIT to at least 14-15% in the coming year. So I think that's our objective. The point I'm trying to make is whenever we see an opportunity, we will be putting a priority on growth over immediate impact on the margins. So I think that's the point I'm making. However, based on whatever wins we have and whatever wins we are in the pipeline looking at, I think we will be able to maintain our margins at about 14-15%.
Okay. If you could just guide us on your order wins as well. I think Q3 stood at around $29 million, which included $18 million of new deals and $11 million of renewals. What can you guide on when it comes to, say, Q4 and exit run rate when it comes to the order book and the trends for FY25 preliminary, if so?
I think our focus is, like we said, focus on our 60 marquee customers that we work with, and in the matter of about 2 to 3 years, see how we can scale that to at least $3 to $4 million. historically what we have done is focused on few, and because of that, whenever some impact happens over there, we struggle. I think the entire organization is now rallying towards ensuring that all the accounts grow systematically quarter on quarter. So I think that is what I mean when I say significant. Along with that, also is the focus on winning larger orders, larger deals,
Right.
and longer term deals. So I think we have seen those movements happening in the third quarter also. And that is a positive movement. And that is that 18 million number that we are talking about. Those are all long-term deals that we have recently signed, and we see that momentum continuing.
Quickly, before we let you go, Rajiv, if you could give us a sense of the amount that you're looking to invest in the Japanese subsidiary. The board has, given you an approval for strategic investment in the areas of AI, 5G, power-driven, IP licensing, etc. What's the amount that you've earmarked, and by when do you deploy all of this?
I think the amounts that we are looking at deploying in Sasken Silicon is $6 million. In Japan, we are planning to invest $1 million, up to $1 million. We have existing customers over there, so intent is to set up a subsidiary serving Japanese customer out of Japan. So there, it may not need much of an investment because I think it's more a runway that we already have created, and now it's only execution.
Okay, all right, Mr. Mody, we're going to let you go on that note. Thanks very much for joining in and speaking to us. So that's Sasken Technologies. The stock is down around 3% after what was quite a disappointing quarter. We need to take a short break, but we'll get you more on the markets. A lot of stocks floating around. More action on the other side. Stay tuned.